Hey, John, it's that time of year again. It's time to take a look at your taxes and do some tax planning. This is where the action is with taxes are, so I love it. Let's talk. Hi, I'm Bridget from I've got a fee-only financial planning practice in Chicago, Illinois.
And I'm John Shearer. I've got a fee-only financial planning practice in Middleton, Wisconsin. And before we dig into tax planning, I want to remind everybody to hit that subscribe button, help other people find this information on YouTube. And with that, I'm looking forward to digging in. We said it's that time of the year. I started to think about Thanksgiving or maybe Christmas or Hanukkah and presents and treats. And then you brought up taxes. So I'm not sure if that's a good thing or a bad thing here.
Well, this is the time of year to plan your taxes. And that is where you can save money on taxes. It's with planning. It's not with actually doing the tax return. And most of the tax provisions need to be done before January 1st. So before December 31st.
Right.
So this is the time to think about it.
Isn't that the thing we think about tax season being spring, right? Oh yeah, tax season's April. Like no, the effective tax season's now, right? Before the end of the year, where you can actually make a difference. That's so awesome. So what are you telling clients, or what kind of conversations are you having about tax planning here before the end of the year?
So let's talk about pre-retirement. So this is before you're retired, and a lot of our clients are 1 to 5 years away from retirement. Some are earlier, and these are still going to apply. All right. So the thing about before you retire is that you don't understand this, but you can't control your income. So when you have a W-2, some people are like, are there any loopholes? Like, you got all your income just showing up every year on this W-2. You get it, the IRS gets it, you have to pay tax on that. So once you retire, so later, you're going to have a lot more flexibility about where you get your income. But in general, people don't really understand that, because you can be taking income, you can get the same amount of money, but take it from different sources, and it'll show up on your tax return differently. So there's a lot more tax maneuvering to be done on the income side. So before retirement, you want to try to get as many deductions as you can. All right. And so let's just go through these deductions. First of all, let's talk donor advised fund. All right, so these are itemized deductions, and we've done a whole episode on donor advised fund, but you got to think, okay, can I contribute to charity, perhaps with appreciated stock, maybe grouping my deductions in 1 year so that I'll be itemizing this year if I'm not itemizing otherwise. And is this the year to do it? So that I can put a bunch of my deductions until probably the deductions I'm going to want until I'm 70 and a half in most cases, all while I'm still working. What say you?
Yeah, no, that's such a great idea. And the thing that comes to mind that we talk about a lot with folks is that when your income is the same year over year, there's less things that we can do, right? And you just described, you get a W-2 every year, you get a paycheck. When you have changes in your income from a tax standpoint, that's when there's some strategy or more strategy that comes into being. And as we start to talk about these folks, as you approach retirement and you go, hey, in 2 years, next year, 3 years, my income from a cash flow standpoint, my taxes are going to be a lot lower than they are this year when I'm getting that W-2 income, right? Showing up on my paychecks. Like that's that delta that we talk about a lot is tax deductions today are more valuable at my current tax rate than they will be in 2 years when I'm retired and maybe living off money in the bank, right? I mean, you think about, we tend to talk about cash flow in retirement rather than income, and specifically using that word because what I care about in retirement is that money shows up that I can spend, right? I don't care whether it comes from the dividends off of my investments or the interest from the bank or where at principal or 401k or whatever. I just want to care about where it's coming from. So that cash flow thing. And if you think about it, right, if we've got money in the bank, let's say I've got a CD that matures, I'm going to retire next year. I got a CD that matures in January, and my spending is $100,000 and the CD is for $100,000. Great, I've got my cash flow for my first year of retirement, but what's my tax situation? right? When that CD matures, that's not taxable income to me,
Yeah,
right?
you've
My
been paying.
taxes might be zero,
Right.
but yet my cash flow is that $100,000, right? So that's that difference that we're talking about here. And
Right.
so that idea I think is important to understand and think about, well, wait a minute, I need money to live on. Yeah, but it's not necessarily taxable money depending on your circumstances, right? But I know you try to get people in that same spot. And then we take a look at, hey, next year, if my tax rate's going to be like 0 or 10% or something like that, and this year my tax rate is 22 or 24 or 35 or whatever, golly, and I'm giving money to my church and to United Way and to the hospital and these sort of places. How can I put that money to use and make the tax deduction today at 24% and not take it next year at 0%, right? Like that sort of concept, which is exactly the same thing as you're describing. It's a really powerful thing as you start to approach retirement here.
Yeah, absolutely. So uh donations in general, if you're itemizing, again, if you're itemizing, and donor advised fund, again, if you're itemizing, and you can create itemizing by putting a bunch of years deductions together. And again, we put this all together in a different episode. Okay, so we've got that, and then we want to just make sure. Okay, so here we have some basic. I call it financial hygiene. Make sure you're maxing out your 401k. Now, people think they are. Guess what? Take a look at your paycheck and make sure you
That's
are.
right.
Add more if you haven't, because that is one of the things that we look at consistently, and people think they're maxed out, but they're not. And it's just normal, like, because you don't always.
Right.
So make sure you're maxing out your 401k. And then we've got the contribute to a Roth IRA or a backdoor Roth. Okay, so why don't you talk that through? Because this isn't as much of a play on difference in tax rates. This is a
Right.
different rule that we're going to be talking about. But go ahead and talk about the.
Right. And so some of these things, as we start talking about approaching retirement, right, in a year or two or three, whatever I'm retiring, I'm not going to have earned income, right? So my
Okay.
tax situation is different. That's what we've been talking about so far. But this one that you just brought up, and we do the exact same thing as you are, is you can make contributions to IRAs, Roth IRA or regular IRA, to the extent you have earned income during that year, during that calendar year, right? So in 2 or 3 years when I retire, if I don't have any wages, I don't have any earnings, I can't put money into an IRA. I can't put money into a Roth IRA. But today, while I have wages, I can, right? So it's not a matter of tax arbitrage necessarily, but using IRAs, especially the Roth IRA, whether you can do it directly or do that backdoor Roth thing, right? But putting money into a Roth IRA has tax advantages over time, right? And when money's in Roth, it grows tax-free basically, right? Some caveats, but that's essentially what we're talking about. And so taking advantage of the ability to put money into a Roth IRA that's going to produce tax advantages down the road, where again, today I've got that ability while I'm working. When I stop working, I don't have that ability because that's how the tax law works. Right.
Yeah,
So not saving taxes today, but putting ourselves in a good position for the future.
there's one caveat with that too, and that is that, say you're retired, but your spouse has some income, or say you've got a little bit of income. You're making at least $8,000 from a W-2. Or like you retired that year and you still have that those wages. You're retired now, but you retired and you had part year. And I've actually told people to retire in February, just so that we could do the Roth IRA that year. So you don't have to have a ton of income. And it could be your spouse's income. In that case, your spouse would want to have $8,000, assuming they're over, what is it, 50, and
50, yep.
so that you'd want to have $16,000 of spouse income, and then you could both do IRA or backdoor Roth, Roth IRA
Yep.
or backdoor Roth IRA contributions.
Yeah. One thing that just popped into my mind as we're having this discussion is that we've got a client and I divorced, so she doesn't have a spouse, but she was getting alimony, and you have to check the rules. I believe it's technically titled as alimony or maintenance. and that counted as wages for the purposes of putting money into a Roth IRA. And I think it had to tie in with that, well, hey, it's not my current spouse, but my ex-spouse paying me this, right? But there's a place in the law, and you have to look up the details. Don't take this and go and do it, right? But take a look. Hey, if you're getting alimony, check and see if that counts as income, because there is a circumstance where it does. And again, it can be a spot where I can take money. I got money sitting in my checking account or my investment account. I can put it into Roth IRA, right? To the extent I have that alimony or support, no tax difference now, but all the future growth is tax free. That can be a nice place to have some extra tax bang for your buck.
Yeah, last suggestion, and this is again only if you have this, which is make sure you're contributing to the max to your health savings account if you've got one of those. So
Yeah, that's great. That's great.
I would say 10 or 15 or maybe 20% of the people have those, but then you make sure you remember to use that and put the money in. Although I think you have until April 15th on that case, but it's really, again, better tax hygiene to just do it before the end of the year. Then you've got it all your records easy, and it's easier to do your tax return too. So you give tax preparer or yourself a break. You're doing that. So with that, I think it's a great time to wrap it up. I'm Bridget Sullivan Ramel. I've got a fee only financial planning practice in Chicago, Illinois.
And I'm John Shear. I've got a fee only financial planning practice in Middleton, Wisconsin. Both Bridget and I are taking on new clients, so we'd love to hear from you. But if you like what you hear on our show and you'd like to find an advisor in your local area, we're both members of the Alliance of Comprehensive Planners, a group of nationwide tax-focused financial advisors, and you can find an advisor in your area by checking out acplanners.org.
And don't forget to subscribe.